Jackie Stennett, a U.S. Army veteran and the Vice President of Academy Women. Thank you all for taking time out of your busy schedules to join us for today's event. We have participants joining today who represent every branch of military service and every duty status from across the United States and around the world. For 2022, Academy Women's Career Coaching Workshop, which is held as an annual event, will continue to extend its reach by bringing you a monthly webinar series. As with our in-person career workshop event, the 2022 virtual webinar series will provide insights from subject matter experts and thought leaders who will share their knowledge on a broad array of topics designed to support the professional and personal development of military leaders, as well as provide opportunities for those in career transition to connect directly with resources and top-tier military-friendly employers. We have an impressive lineup this year, with today's guest, Paramount Bank, and upcoming speakers from Amazon, Leidos, Travelers, Johnson & Johnson, and more. Stay tuned as we announce new speakers, topics, and companies as they are added. Today, we're pleased to welcome our presenting partner, Paramount Bank, dedicated to reimagining the financial institution of the future with nationally renowned mortgage management and creative bank leadership. Thank you, Paramount Bank, for sharing your expertise today and for your commitment to the military community. A special thanks goes out to our guest speakers, Dan McLaughlin and Daryl Malamut, who both hold special ties to the military community and who work diligently behind the scenes to provide financing strategies and options our community can use to build and grow real estate investments. You'll meet Dan and Daryl shortly, but first, I'd like to introduce Susan Phelan, who will be your host for today. Susan is a U.S. Air Force veteran, a graduate of the U.S. Air Force Academy, and is the founder and president of Academy Women. We've got a lot to cover today, so let's get started. Please join me in welcoming Susan to the virtual stage. Enjoy the discussion, everyone. Susan, over to you.
Welcome. Thank you, Jackie. We still have a couple of people joining us, so please feel free to jump in here. It's my pleasure to host today's webinar. You are in for a treat. Before we get started, let's do a quick orientation. Feel free to move your cursor around to find your toolbar. It'll be either at the top or bottom of your screen, depending on what kind of device you're on. Using the Q&A tool, feel free to send in questions at any time. The Paramount team and I will do our best to answer all of them at the end of the presentation during Q&A. This will be an interactive virtual event, and we'll ask you to participate via the chat window by raising your hand and via your participation in polls. At this time, I'd like you to find the raise your hand button and select raise your hand. And this serves as a simple radio check and lets me know that you can hear me. All right, so if everybody could do that. Oh, fantastic. All right. Great. Okay, so you can go ahead and lower your hand. And let's get started here. I'd also like to show you a quick disclaimer to help you all understand that these are obviously the remarks of Paramount Bank, and we basically lend them the expertise to share with you. And before I turn it over to Dan and Daryl, just a quick note, we're going to be doing some polls. So I am going to launch our first one as a test just to understand who's in our audience. So go ahead and tell us where you're coming from and who you are. All right, can everybody see that poll? Great, thank you. All right, thank you so much for participating in that. And I'm going to hand it over to Dan and Daryl.
Thanks, Susan. Can you advance the slide, please? That's us. I'm the one on the right and Daryl's the one on the left. We'll talk more about who we are and what we're all about in another slide or two. You advance the slide, please. Thank you. So hello all and welcome to our webinar, Real Estate Investing, Leveraging the VA Loan and Alternative Financing Strategies to Build and Grow Your Portfolio. I'm Dan McLaughlin, a mortgage loan officer at Paramount Bank, where I focus on helping military personnel, both active duty and veterans, via the VA loan, as well as other loan products. My connection to the military comes from a source that's near and dear to me. That would happen to be my wife, Kelly. Kelly is a West Point graduate and a U.S. Army veteran. And a fun fact, Kelly and Jackie Stennett, who you saw in the video a minute ago, the VP at Academy Women, were classmates at West Point. And I'm also the son of a World War II Army veteran. And both Kelly and my stepfather have given me a deep appreciation of and a huge amount of respect for what it means to serve our country. With that said, now I'd like to turn it over to Daryl to introduce himself and kick off the presentation. Slide, please.
Thanks, Dan. Hello, everybody. I'm honored to be able to present to you today. As the slideshow says, I've been in the mortgage industry right around 22 years. I've been doing VA loans for close to a decade. 5 years ago, I got the honor to go to the Army-Navy Gaming Gala. Seeing the beauty of it and talking to so many veterans, I realized my new passion. It was to try to help and educate as many prior and current members of the armed forces as possible. Hopefully you pick up a lot of knowledge from this presentation, and later on today, tomorrow, or whenever you want, we can do one-on-ones and answer all your questions individually. Advanced slide, please. Today, we're going to be doing the Paramount Bank overview, the VA loan features and benefits, scenarios. Dan's actually going to lead us through alternative non-VA loan financing strategies, and we're going to finish out for the Q&A. Please advance. You served your country with honor. Now let the VA program honor your services. Please advance. Paramount Bank, we lend in all 50 states. That comes handy for veterans on the move, especially if you are in service. Prioritizing VA loans for us is important, as a lot of other banks will just put you in the easiest loan for them. We will put you in the best loan for your situation, meaning some have service-related disabilities and have big funding fees. And we'll put you in what we would do is we'll put you in a conventional loan and a VA loan side by side, and we see what's going to work best for you. That's so important because you want to get the best deal no matter what. We do not charge any origination fees on VA loans. Okay, some other companies do. And also, we work with over a dozen investors to be able to shop around for you to show you the best rate and the best deal for your family. Please advance. Why go VA? You are allowed to go up to 100% loan to value on your loan and not put any money down if you have your full entitlement. On a conventional loan, you have to put anywhere from 3 to 5% down. FHA, you have to put down at least 3.5%. On top of that, on conventional and FHA loans, they have a thing called private mortgage insurance. It's an extra payment when you go over a certain limit. With conventional, if you go over 80%, you are going to pay PMI. FHA, no matter what, you're going to pay PMI. So that's so important to, if you're not going to get with Dan or I, get with someone, make sure you're not going an FHA loan unless you really, really have to. Now, Paramount Bank, we waive origination fee for veterans only. Last week, a veteran came to me and said, hey, I want you to look at something for me. And they showed me a locked loan estimate. And it was locked with the first company with the name of veteran, won't give the last name. And it was 100% service-related disabled veteran, and they were charging $3,500. So please do not pay an origination fee. And then the last but not least, flexible underwriting parameters. We or the VA will allow you to do everything in their power to get you a loan. Conventional on debt to income ratios, which The amount of debt you have to the amount of gross income you have conventional will only go up to 45 to 50%. FHA on your principal, interest, taxes, and insurance, HOA, they'll actually go up to 46.99. And with the amount of debt, will go up to 56.99 on your debt to income ratio. Now, on VA, last week, I saw a couple approvals anywhere from the high 60s to even at 70%. Now, again, you have to be approved through the automated system, and it's case by case, but they do have that flexible underwriter parameters. Next slide. What does a VA do? The VA provides a guarantee on the loan. They task the lender with evaluating the risk and lending money, and each individual banks evaluated differently. There's almost 5,700 banks in the US. Next slide. Call us, not the VA. The VA works like an insurance company. When you call them and ask them if you think you will be approved, they will tell you yes, because they have nothing to do with the financing of the loan, only insuring it. The lender and investors are the ones that have the overlays. So again, do not call the VA, call Dan or myself. We can go over this one-on-one with you for your individual situation. It stinks if you find your dream home because a VA told you that they could do the loan, and then you call us and we tell you you can't be approved. So please call us, not the VA. Next slide. What are some of the common myths and where do they come from? Next slide. Your benefits expire. They never expire, period. You can only use them once. So false. Not only can you use them once, but you could keep using them and using them. You can only have one at a time. In my first scenario here in a minute, you will see that's false as well. There's a limit to the size. The VA has no limit, but banks each have their own limit. My credit isn't good enough. This myth is false. At Paramount, we go down to a 620 score, but we have a lot of people we work with under 620 that we try to do credit simulators for them, and we can try to get your score up, and most of the time they qualify. Again, check with Dan or myself if you think you're in that situation. You can't have another VA loan after foreclosure. That's also false. The waiting period is 2 years, and we will have to check the math on your entitlement, but it doesn't mean we can't do it or that you have to put any or a lot of money down. I have to wait to get a VA loan after a short sale. This is the only tricky one here, as a VA doesn't make you wait, but some investors will. If you run into the scenario, please give us a call. VA appraisers are too restrictive. The VA appraisers protect the veteran like no other. They make it that when you close on a home, it is a move-in ready home, and there are no issues with the home. And last but not least, they are too expensive. If you have no service-related disability, then in some cases, a conventional loan, because of the funding fee, might be cheaper, but we'll cover that in 2 slides from now. Next slide. Calculating entitlement and maximum loan amount. There's no cap on the number of VA loans a person can have. The VA loan only needs 25% guaranteed. We'll go with that in a couple slides. There's no cap to the dollar amount of a VA loan. But as I said, there's a bank cap, and right now Paramount is capped at 2.5 million. So the next one, there's no down payment requirement for a VA loan. If you have 100% entitlement available, then you can go 100% loan to value. So at Paramount right now, if you have all your entitlement, you could actually go to 2.5 million. Next slide. This is the VA's funding fee. This is very important, okay, to know, and a lot of veterans don't know about this or have not came into this before because they've never done a VA loan. Your first time use, if you have no service-related disability, and you're going to put down 100%, would be 2.3%. Now, what's important to know about this is that the 2.3% sits up top the loan. Okay, so you don't pay that out of pocket for closing costs. So for every 100,000, okay, it's 2.3%, or in that case, $2,300. Now, you can put down money that will bring that funding fee down. Okay, that's also important to know. 5% or more, up to 10%. Instead of 2,300, it would only be 1,650. 10% or more, it would be 1,400. After the first time use on a purchase, this is huge because if you put less than 5% down on $100,000, you're putting down 3,600. So for every 100,000, you're putting down 3,600. If you just put 5% down, you're almost saving 2 whole percent on the funding fee. So that is really important to know. And on every cash out refinance, you're putting down, because you've already done a purchase on a VA, 3.6%. On the VA IRRRL, which I'll go over in my last slide, it's actually 0.5% with no service-related injury, disability. Next slide. Leveraging the VA loan in 3 scenarios. Now understand this, I talked about a lot of things I was going to talk about in my scenarios. Here come my 3 scenarios. Next slide. I know some of you are here to learn how to take advantage of building a portfolio. Scenario 1, having multiple VA loans. If you have entitlement, you may be eligible to keep your property while purchasing your next owner-occupied property. Here's my first scenario. Katie, 5 years ago, was going to buy her first home, and she does have a service-related disability. She finds out she lives in a county that has a county loan limit that is $647,200. What that means is if you are in a county that has that loan limit and you have more than one VA loan, on the second VA loan, we need to find out if you're borrowing over the loan limit, then you're going to have to start putting money down. For this scenario, Katie is buying homes all in that same loan limit, $647,200. In Katie's situation, she is buying a $200,000 home. She doesn't have to put down any money besides escrow and title fees. Then Katie decides to buy another home a year later for $200,000, which now she's going to rent her other home and start her portfolio. She then, a year later, does the same thing at $200,000, and she still does not have to put any money down. Katie, earlier last year, bought another home at $200,000. So that brings her total that she's borrowed in the beginning of the loan up to $800,000. She now has 3 rental properties and 1 primary home, all VA. On the last home, because the VA insures 25% of the loan for every dollar Katie borrows over $647,200, she has to bring 25 cents on the dollar, or in this case, $38,200. Please see Dan or myself individually for your own examples. I really want to stress that every scenario is different. Let us do the math for you. Next slide. Leveraging the loan, scenario 2, cash out. For the last 22 years, I've been coaching families on how to save money on their bills. The biggest issue with most is they don't know how much of a difference compound interest is from simple interest. Simple interest is your car, personal, and mortgage loans. One payment with a term. Compound interest is your line of credit and your credit cards. Interest that is compounded daily. This is where rates on your mortgage really don't matter. This, whereby rolling everything into your mortgage, is going to save you a lot of money. Example, Jennifer, who is transitioning to a civilian, has a home that she owes $100,000 on and has a 3% rate and pays $900 a month, including her taxes and insurance. She has racked up around $25,000 in credit cards that she pays $1,000 a month on. Unfortunately, she's going to have her rate go to 5% on her new loan because of 2022, and her payment go up to $1,175 with tax and insurance. Remember, rate is just a number. It all depends on what you get for that rate. Jennifer is going to save $725 a month, and now she has more money to put in her pocket. And when rates come down, she can do a VA interest rate reduction loan. Again, I'm going to go over that in my last slide. To simplify the debt consolidation loan, name 5 things you can buy with an interest rate, and name 5 things you could buy with an extra $8,700 a year. It's endless. Next, we will talk about the efficient sources of funds. Your home is your biggest dormant asset. It's just sitting there and you can use it for many different things. In the last 6 months, the Feds keep raising rates for banks to borrow money. That's affecting personal loans and lines of credits, credit cards, and everything else. Instead of taking a loan like that, use the equity in your home to take out the home improvement money, the tuition money for your kids, and other major purchases. Finally, we have an investment opportunities that can be life-changing, and you can use the equity of your home to do it. Jackie is now a civilian and has an unbelievable opportunity to start a company that she knows is going to be successful. But she only has 2 months to get $200,000 to start the company she always wanted. Jackie calls Daryl and gets the money out in a month. The last example is Missy, who just became a civilian, has a dream that she wants to be a day trader and has already started it, and she's been good so far. She needs money to make her more money. She takes out $250,000 in equity in 1 year. In her first year, she makes $45,000. And even though her mortgage payment went up and she paid an extra $19,200 for the year because it went up, her net profit was $25,800. Next slide. Oh, actually, keep it on that one, please. So purchasing a multi-unit owner-occupied property. So I have a veteran, Kelly, who had 10 VA loans in her lifetime. Kelly has 2 years left as a firefighter and wants to sell her only VA loan she has left and move to Apollo Beach, Florida. Kelly can't buy a single family home because her debt to income ratio will be at 80% and won't qualify. So we looked at a multi-unit investment property to qualify. First, the 4-unit property is all rented at $2,000 a month by each tenant. So that's $6,000 a month. On a VA loan, they will count 75% of that money for income for you to qualify. That's $4,500 extra dollars. So with Kelly's firefighter income at $4,500 and the extra $4,500 at $6,500 and the extra $4,500 she got from the rental income, I got an approval for a $1 million 4-unit property that she wanted. The next part is amazing. She is getting $6,000 in rent right now, and rent keeps on going up. So by next year, her whole mortgage payment will be paid by other people, which is just incredible. Next slide. Choose your VA lender wisely. So I want to give you an example of something that just happened to me last month. I had a veteran, Jose, and we worked together for a while to find him a home in Florida. Jose's wife decided to talk to a certain agent, and they decided to go with him instead of the agent I always used in Florida. Well, the one thing I know after 22 years in the industry is not every lender and agent is created equally. We were down to the last 10 days before close, and we got a WDO, which is a wood destroying organism report, which you have to get in certain areas in the country. And in there were rat droppings and holes in the attic where the rats came in from. Our agent started yelling at me after I told him the seller of the home is responsible for fixing it before my veteran moves in. The agent said that he had another lender that he did 43 loans with just last year, and that lender said this is ridiculous. The agent wanted my veteran to pay $900 to fix it. I sent him the VA guidelines and saved our veteran $900, and Jose got to move into the home rat-free. Also, when we got to the closing disclosure, which you send out 3 days, it has to be signed 3 days before closing, he called yelling at me again, saying that the broker fee of $300 should be paid by the veteran. And the same other lender charges his veteran every time. I laughed and said, you and the other company should know that what the VA policies are, and that company should be reported. The veteran does not pay that fee. The moral of this slide is you need to know that what is going on with the VA rules, and a company knows and abides by them. Next slide. Now I want to introduce Dan McLaughlin again, or send it back to Dan, with alternative financing strategies.
Thanks, Daryl. So let's take a look at some alternative financing strategies. There are several options for financing properties that fall outside of the traditional conventional mortgage. The loans we're going to discuss today are known as non-QM, or non-qualified mortgage loans. With non-QM loans, borrowers can qualify for a mortgage based on alternative methods instead of the traditional Fannie Mae or Freddie Mac standards like income, work history, debt to income ratio, et cetera. As such, non-QM loans can be an effective source of financing for self-employed borrowers, business owners, or those with an inconsistent income flow, people that sometimes have a difficulty in qualifying for a traditional mortgage. So there are several investors that offer non-QM loans, and each has their own specific guidelines, and they can vary significantly from investor to investor. So it's really important for the borrower to work closely with the lender, us, to identify the best program for them. And if you go this route, you'll definitely want to work with lenders that know this space. So reach out to Daryl or myself to discuss your specific scenario, and each scenario truly is different, to learn more about non-QM specifics after the webinar. Next slide, please. So we're going to take a high level, like 30,000 foot look to help introduce you all to the three most common types of non-QM loans, to give you a basic idea of what could be available to you. They are the investor cash flow loan, also known as the DSCR loan, which stands for debt service coverage ratio, the bank statement loan, and the asset qualifier loan. Next slide, please. So the first one we're going to touch on is the investor cash flow loan, or the DSCR loan, debt service coverage ratio. The cash flow loan enables a real estate investor to finance an investment property using the rental income, just the rental income generated by that property. Investment property loans can be closed very quickly with minimal conditions. And the great thing is there's no real documentation necessary, no tax returns, no proof of income, no debt to income analysis, and no proof of employment are required. So bottom line is if the debt service coverage ratio is greater than the debt service, meaning what you're paying on basically your mortgage, one can qualify. So let's take a quick look at a scenario. Debbie and Jeff, self-employed real estate investors, want to buy a 4-unit rental property to add to their portfolio of rental properties. They have no job history as they've been self-employed real estate investors for some time. And they prefer to use debt rather than their personal income to qualify for a mortgage. So they decide to pursue a DSCR loan. And with that, we take a look at 3 key areas: the debt service, which is essentially your mortgage, your principal and interest and taxes and insurance. And in this case, the property is, the mortgage is for $8,000 a month. And then we look at the rental income. And the rental income on this property is $9,000 a month. So you can, right there, you can see it's $1,000 more than what you're paying on the loan. So then we calculate the DSCR by taking the rent and dividing that into the mortgage payment. And we see that the ratio that we get is 1.125%. So in this case, it's over 1.0. So it's cash flow positive and the property qualifies. So that's pretty much as straightforward as you can get. And you simply have to meet the investor guideline for a down payment and you're good to go. Next slide, please. Next, we're going to look at the bank statement loan. This loan, you use bank statements to verify income instead of W-2s or tax returns. So it's a good option if you're self-employed, a business owner, or don't have a steady income, as I said previously. So the scenario we're going to look at today involves the Pestos. The Pestos are successful owners of a pizzeria business, and they have been in business for 8 years. They have 7 locations. They've decided to pursue an additional income stream. They're very entrepreneurial, and plan to buy an investment property. They consistently deposit $80,000 per month from their business into their personal checking account. And they decide to apply for a bank statement loan using their personal checking account. So the first thing they do is contact their accountant or CPA and asks that person to determine the business expense ratio, which in their case comes to 20%. We're talking about things like rent and utilities, monthly expenses, not deductions or write-offs on the business. So it comes to 20% in the case of the pestos. So we take that 20% right off the top of that 80,000 to calculate the income. And that leaves us with 64,000 a month in income. So they can qualify by providing the 12 months of bank statements showing deposits and withdrawals from the same account, meeting the minimum credit score or above, and typically comes with a 20% down payment. But as I said earlier, the investor guidelines are all over the place. Some may want 30%, some might only want 15% down payment, for example. So again, we'll look at what the options are if somebody comes to us and is interested in a bank statement loan. Next slide, please. The last one we're going to look at is the asset qualifier loan. And here we use only liquid assets rather than employment income to qualify. And by liquid assets, we're talking about cash in the bank, stocks and bonds that can be liquidated easily and quickly, and retirement income like an IRA. So no income, no employment verification, no tax returns, or DTI ratio is required to qualify. So again, this is another good option if you're self-employed or a business owner or have a variable income. So in this scenario, we're going to look at Marianne, who is an investor in private equity funds. Marianne wants to buy a second home, and she has $4 million in liquid assets. Her income is sporadic due to the long-term payout nature of her investments. So she decides to pursue an asset qualifier loan. Her $4 million in liquid assets computes to a monthly income of $11,000 a month. And the way we get that is we take the total liquid assets, the 4 million, divided by 360 months, which is the duration of most common mortgages. And that's the 11,000 in income. So she can qualify as long as she has total liquid assets equal to or greater than the loan amount. And we haven't determined that loan amount yet. Has reserves over the loan amount, meaning money left over. So she's not wiped out by covering the loan, and then funds to close, closing costs, and then meet the other investor guidelines, which typically deal with down payment and FICO credit score. So that's the third and final one. So that should give you hopefully a feel for the three most common financing alternatives in the non-QM space. Again, Daryl and I are happy to discuss your specific questions and scenarios after the webinar. So now I'm going to turn the stage back over to Daryl, who's going to provide a brief state of the union on mortgages.
Thanks, Dan. As a lot of you know, the mortgage industry has been as predictable as the last couple Army-Navy games in 2022. Rates have more than doubled in the last 6 months. The last 40 years, the rate average has been around 7%. Dan's first home he bought was around 12%. My first loan I did in 2000 was around 10%. Buying a home in the high 4s and low 5s is not the end of the world. When people ask me what I think about buying a home in this market, I tell them very simply, if you can afford to buy a house in this market, you should jump on it. If you buy, you are gaining equity in your home every month. You own it if the market stays right. Extra money for you, your family, and your portfolio. On a $300,000 home right now in certain cities, you can get a PITI payment at $2,000 a month. For that same house, rent might be $2,500 to $3,000 a month. Here are 5 random cities and what their percentage of rent increase was from 2021 to 2022. Denver, Colorado, 13%. Pittsburgh, Pennsylvania, 15.5%. Arlington, Virginia, 18%. Tampa Bay, Florida, 22.4%, and New Orleans, 12.8%. And nationally, the average on one chart that I looked at was between 15 and 17%. So, given these numbers, it's better to own than rent. Also remember this saying, you marry your home and you date your interest rate. Being a veteran or in service has its privileges. You have a product called a VA interest rate reduction loan. It's the easiest loan you could ever do. Once rates come back down, you can take advantage of this product. You must be in a VA loan for at least 210 days before you can redo this loan. No appraisal, no income check, and no WDO. The VA has this program to help you save money, and it's one of the best programs out there. Contact Dan or myself, just give us your rate, put you on a list, so when rates come down, we'll do our best to put you in one of these loans as long as qualifications are there. Again, thank you all for listening to this presentation. Next slide. We can also help with FHA, conventional Fannie and Freddie, jumbo loans, 25 days, express closings, and much more. And next slide. Thank you from the bottom of our hearts for listening from Paramount Bank. Next slide. And here you go, Susan.
Thank you, gentlemen, so much for sharing such great information. I'd like to open it up to our attendees for questions. Please use your Q&A feature on your browser and submit your questions. I'll go ahead and read them out and we'll get answers to you immediately. If you have a question that cannot be answered or is more personalized, please feel free to follow up with Daryl or Dan after this webinar. And we'll be posting their contact information very soon. So the first question that's come in from Shirley is, my current situation is that I want to do a cash out refi on my VA loan funded home as I need the equity. I want to know if I'm able to do a VA cash out refi on it if I don't currently live on it or live in it.
Unfortunately, Shirley, that is something that you cannot do. You have to actually live in the VA home, okay, to actually do a cash out on that VA loan.
Okay, great. Next question from Daniel. What does after first use mean?
After first use, so the first time you use your VA is gonna be a purchase. Okay, so you're buying your first home. That is your first time use of the VA. Anything after that is subsequent use. So that means you go to the second tier. So you're on that tier of 3.6% if you buy another home, 3.6% if you do a cash out refi, or if you want to put down 5 or 10% down, then you could actually drop that down a little bit if you're buying another home.
Thank you. A question from Respa. Does Paramount Banking offer recasting? If so, how many times?
Recasting. Can you be more specific?
I don't think so. Respa, can you add anything else to your question? All right, then. Unless I hear otherwise, I don't know if we can add anything to be more specific. Does recasting mean anything, or could it be refinancing?
If it's refinancing, then absolutely we offer that.
Okay, great. And then how many times could you refinance?
As many times, well, they limit your refinance to, again, every, I think, 210 days, but you could refinance every 210 days if you wanted to, all the way up until you hit your 100% loan to value. Right now, like the difference of 90% and 100% on a cash out refinance, the rate is crazy difference. But if there's a lot of benefit there, like I said, on my scenario 2, then it's definitely something you want to look into. Yeah. And that's why the one-on-ones are so important, that we do them, because it's every situation is different.
Thank you. Addressing Jim's question, yes, we will send out a copy of this presentation with the slides so that you all will have a chance to go through this again if you'd like at your leisure. Another question from Jackie, what is the minimum credit score for a VA loan? And what are options for those with suspect or bad credit?
Dan, you want me to take it or?
Yeah, you can take it because you touched on it in your presentation.
Okay, so 620 right now, but you have to understand a couple things with this. I mean, you have to get an approval. Okay, so you have to actually get an automated approval to actually do these VA loans. And we won't know if we do that without running credit and seeing where you're at. If it's under a 620 score, we have different things that we could do. We could call the credit company. We could do a credit simulator. So what a credit simulator means is, let's say you have 5 credit cards and you have a 590 score, and 3 of those credit cards are $500 limits, and 2 of them are over the 500. So you owe 505 on those. Well, if we bring those down, if they pay those down, the simulator will tell us if you just do that, then your score could go up 40, 50, 60 points. And then you go from not qualifying to qualifying. So what we like to do, Dan and myself, is to educate, okay, people and do that for them, because the regular banker, you go to, again, just using one bank, I'm not saying they do it, Rocket or someone like that, sometimes people just don't call you back. So they won't explain to you what is the next step if for some reason you can't get approved. That person, that loan originator should always call you back and should always be there to explain that stuff to you and give you your next step so you could actually buy a home or do a refinance.
Thank you. Question from Daniel. Are there any VA insured loans for owner builder lots? He has 5 separate lots that he wants to build homes on with the intention of renting them out or selling them.
Right now, we do not like to do construction loans like that. I will just double check, and if you want to give us your information, after this, I will just triple check on the actual construction loan if we're actually doing that VA that way. And if you're going to do that and you're going to go VA, you have to live in the home for at least a year.
Okay, and I think that answers Shirley's question around how long would you have to live in the home to be able to do a cash out refi? Is that also a year?
A cash out refi is actually 7 months.
Okay.
Like 210 days. You got to at least make 6 payments and be in like it for 210 days. And yeah, we have to figure that, we could talk about that like offline. I can explain everything to her.
Okay, great. Another question from Jackie. Do you have to live in a multifamily investment property, or are there any other options around this? If so.
Do you have to, okay, live in a.
So like the example of the 4-unit property that Daryl gave, I forgot the name of the.
Yeah, scenario 3.
Yeah, that person does need to live, if you're using a VA loan, that person does need to live on the premises, but you have the other, in the case of that one, it was a 4-unit deal, and the other 3 were rented out. And after a year's time, the rent was covering the entire mortgage payment. So you do, go ahead.
I was going to say, if you want to rent it out after a year and you're approved for another place, and then it's, that all depends. Like we can look into that as well. Okay, like if somebody else wants to rent that out and you have enough entitlement to buy another place and have enough money to put down, then you could look into that as well. But yeah, like Dan said, 100%. It's only VA's only owner occupied. You cannot buy a second home, and you cannot buy an investment property through the VA.
Okay, great. For those who have joined us late, we will make this recording available so that you can watch parts that you may have missed. Another question from Shirley. What options does she have to acquire a loan for an investment property if she's renting the first VA funded home and living in the second VA funded loan?
She could, if she wants to take cash out of the investment property, she would have to flip it over to a conventional loan investment property, and then we could get her cash out. I think she's maxed out at 75% loan to value. So, for every 100,000, she gets 75,000 out. It might be 80, but I would have to just check my guidelines and see what's available. But yeah, we can flip that to a conventional loan.
Great. Question from Casey. If both Casey and the spouse are veterans and need to live in the property, what is the way to use both VA loans, one being a Purple Heart, the other one medically retired? So there's no funding fee on either.
Is it two properties or one property that we're talking about?
My understanding is it's one property with two different veterans. Can you leverage the two different veteran loans on one property?
I mean, that's a tricky one. You can, but I would have to look more into that particular situation. But if one of them, gets disability, then at the end of the day, like, it's automatically, there's no funding fee on that. So you're not going to have a funding fee, and I would keep another maybe another VA loan open too for another opportunity.
Could they buy two homes at the same time, leveraging both of their benefits?
They would each have to live in both homes,
Right.
and that's the thing. They would have to live in both homes, and then you get into the logistics of, like, how far away are they living? Okay, and now you're, it's, there's certain situations, there's if they live 100 miles away, I mean, there's just a lot of situations. That's something I will check on for you, Casey.
All right. And so for those who have personal questions or want to follow up with more details, I have posted Daryl and Dan's information in the chat, and we also have a slide that will feature their contact information, but please go ahead and mark that down. A follow-up question from Daniel. What if you were to put a pre-furbished modular home that's built off location, then transported and put together on the location? And that's referencing the construction loan for the property that is the land. Would that be something that would get around the needing to live on it, even though you're building a property simultaneously?
I mean, we can't do that construction loan, that construction part of it. Okay. And yes, we would have to, I'm almost positive. Yeah, so hold on. Let me read this again. Can you read that again? What about?
So the question is, what about a pre-furbished modular home that are built off location, then transported and put together on location?
If it's transported and it's on a permanent foundation, and you have, I think, the credit score, if it's modular, then we could look at it, I think, down to a 620. If it's manufactured, okay, then I know we have other guidelines where I think it's up to a 680. But I will check on that. So modular and manufacturer are completely different.
Okay, great. All right, I have a couple more questions, and meanwhile, I'm going to launch our final poll here. Another question that's come in: what would be good next steps for people who are interested in applying for a loan now?
First off, get a hold of Dan or myself. Or send your information to Jackie, and you can do that. I mean, our information is posted right there. And then basically we would take your information, we'd run the numbers, we get you pre-approved. If you're looking to do a purchase, we have real estate agents in all 50 states to where we can obviously assign that person to you once you are approved. And you could literally be looking at homes with a real estate agent this weekend. We're lightning quick that way, and that's something we can do. And I do suggest, and I know, Susan, you talked to me about yesterday or the day before about what's the next steps of everything. And I don't suggest you go look without a pre-approval for homes, just for the sake of fact that the cart before the horse. If you're looking for homes without knowing what you're pre-approved for, and you find something with the 2022 market, two things are going to happen. One, somebody might make an offer that second, get the home. Okay. And two, you want to know what you're approved for before you really go looking out there. Okay, because with all the guideline changes and everything that's happened since COVID, you really want to have a pre-approval in your hand, okay, and an agent ready to make an offer for you.
Okay, that's really helpful. And another question, can you review how to qualify for a loan without steady employment, like in the case of college students, for example?
I mean, you're gonna have to have, employment. You're gonna have income to qualify. So
Okay.
if there's no income there, like you can't qualify for a VA loan. There's gonna be income. And if there's another veteran, and this is just another to add another thing, if a veteran or active duty military is going on a loan and they're going on and having someone else on their loan that's a they're not married, then that person is going to have to put down at least 12.5% and get that loan approved through the VA. That goes for a purchase. So that's another guideline that just wanted to throw out there for people.
Okay, great. Let's see here. Another question. What is meant by a 620 and 680? I think it's in reference to the credit rating, but
Correct. FICO scores that are Experian, Equifax, and TransUnion. That's what we pull from. We take the middle of the three scores.
okay. And what are other costs associated with a home purchase besides the down payment?
On a VA loan, you're going to have, there's no down payment, like I said, unless there could be a funding fee. And then there's title fees, and the seller usually picks those. I can't tell you what they're going to be because every state is different. There's going to be the appraisal that's out of pocket to the veteran. The seller usually pays a termite inspection. Okay, and then there's going to be escrow. So what your tax and insurance are. So if you're in the state of New York, your tax and insurance is going to be way higher than someone in the state of Alabama. Okay, so those are really the fees. And then you get into origination fee, which, as we said a couple times, Paramount Bank has 0 origination fee.
But just also to reinforce a point you made about the funding fee, that is not an out-of-pocket cost. You can pay it if you want as part of closing, but most people tend to roll it into the loan. So as Daryl said, it sits on top of the loan. So that's not an out-of-pocket expense necessarily.
Okay. And then one final question from Nikki. Do you service your loans in-house or do you sell them to the secondary market?
We actually finance it initially, and we typically hold the loan for a month, and then we sell it to the investor community.
Okay, great. All right. So for those who have any other questions, please go ahead and contact Daryl or Dan directly. They are more than happy to follow up with you. And as you've seen in this presentation, they're extremely knowledgeable and will research the question if they don't know it off the top of their head. So please go ahead and follow up with them. The opportunities here are fantastic, and I wish I had known them when I did my loan. So it's a great opportunity. All right. Well, thank you both so much. I'm going to go ahead and just let everybody know that we have another webinar coming up in August featuring Amazon on the 18th of August from 1 p.m. to 2 p.m. Eastern Standard Time. So go ahead and mark your calendars for that. Registration is also open at militaryowls.org webinar series. And in addition to this upcoming webinar on the 18th of August, we will also have presentations from Leidos, as well as Travelers, Johnson & Johnson, and more to come soon. So check out our website at militaryowls.org. And you'll see opportunities there for not only webinars, but also career transition resources and other reference documents. We have another special opportunity for those who are interested in finding employment opportunities now, or at least making yourself visible to hiring professionals who are anxious to bring on veterans to their organizations. we have what we call a professional profile directory, and that can be found at militaryals.org, where you can enter your information and employers will follow up with you with opportunities, or just be there to answer any questions you may have about their particular organization or even their industry. So definitely take advantage of that. All of our partners are extremely reputable and just a fantastic resource for you as you're either transitioning or looking for new opportunities. All right, well, on that, I'm going to go ahead and end our session for today and remind you to follow up with us on Facebook, Twitter, and YouTube, and wish you all a fantastic day. Thank you.
Thank you all.
Thank you.